Sheen on a pile of hookers.
That boy sure knows how to party.
Winning.
You bet your ass. And speaking of such, check out this new song by one of my favorites, Scuzz Twitley.
Porn stars, wet bars, driving around in fancy cars, high price hookers, bags of coke. Pass the pipe and take a toke. Strip show, killer blow, $1,500 hoe. Double D's bouncing in my face. Let's go nuts and wreck the place. Let's get loaded. Let's get mean. I wanna party like Charlie Sheen. I wanna party like Charlie Sheen. Lap dance, no pants, that's what I call romance. Long legs, mini skirts, drinking till my liver hurts. Get ripped, get stripped, get $1,000,000 for every script. Let's get $1,000,000 bills and roll like Chuck through Beverly Hills. Down on Sunset, on the Seine. I wanna party like Charlie Sheen. I wanna party like Charlie Sheen. Drinking, smoking, I ain't joking. Let's hit the lights of Hollywood. It's good to get, and the getting's good. Girls that know just what to do jump on you like a kangaroo. We'll get high, we'll get stoned, we'll eat pie, they'll get boned. Drunken orgies, limousines. I wanna party like Charlie Sheen. Let's get crazy, let's get obscene. I wanna party like Charlie Sheen. I wanna party like Charlie Sheen. Let's go.
Okie dokie, good evening everybody. Gonna start with this week's webinar. Another one in our Ultimate Trader Guide series. Basically, throughout this series, going start to finish on everything you need to know about trading. Tonight we're gonna talk about trade planning. We're gonna keep it fairly basic at first tonight and then expand upon it later on. Like always, just gonna ask that you keep your questions pertaining to the lesson. If they're not, they will be overlooked until the end, and then I'll open it up to general questions. Anywho, gonna start out with just basic style of trading that has really been a key way of trading for me, simply because of the ease of it and also the ability to mitigate your risk while doing it. And what that is scaling into swing trades. It's no secret that I don't put a lot of clout into day trading. I personally, though it might seem like I do a lot of day trades, I only do them when I can't find stuff I'm willing to swing trade, and I do them with very little money. I've said for a long time, if this ever became a day trading service, I would leave and find a swing trading service. So, anywho, swing trading's been my bread and butter for a long time, and that's how I plan to keep it. And we're just going to go through a few tips and tools this week as kind of a basic version that we'll expand upon over the next few weeks on how to use scaling into your trades for an effective way that you can trade while keeping your risk a little bit lower on options trades for basically until you can confirm that you're right, which is, sometimes the most difficult thing. And you could look at a chart and say, oh, that just looks perfect. And then, nope, you were wrong. And that happens, and it's going to happen. There's no way to get around that. So what we're going to start with, I've got a daily chart up here of GE. Just a real simple thing. You'll see I zoomed it back to a specific day, January 23rd. Anybody know what happened with January or with GE on January 23rd? They had earnings. And they actually did really good on their earnings. So, this is something that, as simple as it sounds, you can use to effectively navigate through potential trades. I don't like making pre-earnings trades. Those are extremely risky. They can be rewarding, but usually by the time you catch the rewarding ones, you're broke from all the risky ones that you did before that. So the after earnings trades, generally, they might take a day or two to really set up for when you get in them. But for me, it's always made a lot more sense to use existing data and say, hey, this thing beat on earnings. It should go up. Sounds like quite a simple thing, actually. It looks like I may have frozen up my platform here. Give it just a second. Oh, there it goes. There we go. Sorry about the technical difficulties. Anywho, just looking overall, like I said, January 23rd, they had earnings. They beat on the estimates. And, it's pretty likely that when you see that more times than not, that, they might retrace a little bit of the earnings move, but they will typically trend in the direction that earnings statement guided them for. So as you let that settle down for a couple days, and just as a quick question to throw out there, what type of trade for a swing trade do you think you'd be looking for on a stock that beats on its earnings? A long trade, or calls if you're taking the options. To make it really, really simple for you, when we talk about scaling into a trade, when you hear somebody say scaling in, are you putting an entire position size worth of capital at risk on your initial buy? No. For me, when it comes to scaling into trades, I like to scale in by buying in thirds and selling in halves. Meaning I take a normal position size, I divide it by 3. Each buy is one of those divisions. If I get to the point where I want to sell, I never really sell all of it right away. I tend to just sell half of it and continue buying in thirds, selling in halves, buying in thirds, selling in halves, as long as the trade allows me to. Now, with that being said, one thing you'll hear me say a lot, and it's because I mean it, if you can't stomach a 50% loss, at least, don't trade options. Just because, quite literally, the difference in a red day and a green day, depending on what side of the trade you're in, long or short, could literally have very little overall movement, but the premiums move in a way that, it kind of hurts your stomach to look at. So it's important to understand that by scaling in, you kind of protect yourself a little bit. You get to wait until the trade plan actually plays out like you had planned for it to before you put larger amounts of money in. And when it really comes down to it, your first buy is going to be the most dangerous buy you make. If that first buy is your most dangerous buy and you're buying your positions in thirds, how much of your capital for a total position size are you putting in at risk on your first buy? 33 and a third percent. Okay, 33.33%. Which basically means on that first buy, if you're wrong, completely wrong with your trade plan, at least for me, I've learned to just not really pay much attention to it. If I'm wrong, I'm willing to lose 33% because I don't think you should trade options if you can't stomach a 50% loss. Why can I say that? Because, you know, I have a lot of trades that go far beyond that in profit. So when it all comes down to it, with options, the profit percentages are higher. Therefore, the risk is going to be higher. So anybody that thinks you can use a 10% stop or something on options, you're going to stop out of every single thing you ever buy with very little to no win whatsoever. And anytime it does make a decent move, you won't be in it to see it. And buying in thirds kind of helps you ease that emotion of the process it takes. Now, for this particular stock, GE, just kind of going over preparing for a trade entry, as it made its earnings move and that next day, well, you know, it didn't really look too good. This next day it comes down, well, if I'm looking for calls, what's the most basic thing on a chart that I would be looking for? I'm going to put Sam in the corner for never paying attention. You're right, Stephen. We'd be looking for a higher low. Obviously, if I'm looking for an up move, then I want to see a low higher than the last low, which indicates I've got a pretty good chance of making what? On that up move. A higher high. Now, with that first buy being something that, yeah, I'm willing to take a little bit of risk on, I still like to feel like I'm making a buy at a proper time, but at the same time, that first buy, I'm not going to sit and stare and try to get the absolute best buy price possible. Actually, I don't do that on any of my trades just because it's a waste of time. But as we start to see things kind of shape up, on a day like this day, what might I be thinking as I prepare to make a GE trade? And this brings up another good point. When you're going to plan a trade, I'm sure most of you have looked at charts before. You sit down at night, you look at some charts, and you're like, okay, I like these 35 charts, and when you actually look at your account, you might be able to trade 3 or 4 of them. And of the 35 you looked at, 27 did exactly what you thought. The 3 you entered didn't. When you plan a trade, wait for it. You know, narrow your list based on the move it could make based on your trade plan, but wait for it. If it takes a week, so what? Wait for it. The biggest mistake people make is, oh, I'm waiting on this trade, but it's not really available right now, so I'm going to throw my money in something else I've never looked at before, have no clue what's going on with it, and I hope that works. And then by the time your trade comes around, the one you were waiting on or should have been waiting on, the one you planned, you don't have no money to trade it. That's a big mistake people make. So at this point in time right here, as I see the close of this day, anticipating that after an earnings beat, even if it pulled back, I'd get a higher low. And knowing that my first buy, you know, can be a risky buy. So be it. Can be a risky buy. I'm only putting at risk 33 1/3% of an entire position size. And if I'm anticipating a higher low, doesn't it look like I just made that? So if I decided to take my 1/3 buy at the end of this day, now I got to figure out where I think it could go up to. What you're going to find with a lot of stocks is they like to replicate previous moves percentage-wise. one good tool to help you do that. And we're not going to talk a lot about the charting tools tonight. We're just going to kind of throw them up there, and over the next few weeks, we're going to talk a lot about charting. But Fibonacci extensions are a nonlinear Fibonacci tool that kind of allows you to chart a point that mimics a prior move. So basically, what I'm doing by placing this on my chart is saying very, very simply, if it replicates this last move from this low on 116 to this high made on 123, from the low made here on 129, we should hit about $25.22. So now on my first buy, I know it can be a little bit of a risky buy, but I go ahead and make it. Where is my stop going to be for this trade overall? Remember what the key thing is I was looking for. What was the key thing I was looking for as I waited for the trade to set up? What was that key thing? A higher low. So is it possible that even though you got a green candle, that it might go down some and still make a higher low? Could it still do that? Could it actually make a green candle right here on this day and still go down, but yet still make a higher low? Yeah, so one thing I like to do is, and this is why I like Thinkorswim charts, because I can play with them and change how they look. I'm going to thicken up this line, and that's on my lowest daily close right there. So what do you think this line right here indicates? That's going to be my stop, a daily close below there, and I won't have a higher low anymore, will I? And the whole basis for this trade, you know, a lot of people like to overcomplicate it and have a whole bunch of squiggly, jiggly lines on their chart that they don't know how to read. And, you know, if 17 indicators all point the same way and these other 26 do the opposite, that supposedly that's supposed to indicate some sort of buy signal. But it's much more simple than that. Trading's a game of lows and highs and whether they're higher or lower than last time. That's all it is. So the next thing I've got to do once I've determined my stop and the fact that I might want to enter this is determine what I might want to trade. Now, back on January 29th, one thing I would look at for my swings is, first off, how many days did it take to make the last move? This might sound stupid, but 1, 2, 3, 4, 5 days to the top. And I like to add 2 weeks to that. Why do I like to add 2 weeks to that? Does anybody know? Time decay on your options really picks up that last 2 weeks. So I got to add 2 weeks to it just to kind of get myself through that period. And then the other thing I like to look at with my swing trades is, for most of my swing trades, I like to trade a monthly option. Does anybody know why I might like to trade a monthly option as opposed to just some random weekly? This is a good question that a lot of people don't know the answer to, but does anybody know why I might want to trade a monthly option as opposed to just some random weekly? Has nothing to do with the fact that they expire on a Saturday, because you can still only trade them till the close on Friday. The monthly options usually exist for a longer period of time. If you look at an options chain, you'll find that the weeklies only go out so far. And every week, a new weekly option expiration pops up. The monthlies generally have higher overall volume on them as well. A lot of hedge funds that trade options are actually restricted to only trading monthly or even quarterly options. Even one that we look at that can have some nasty spreads at time, like Goldman Sachs. You'll find that with the monthlies, the spreads are generally better than they are on any of the random weeklies. But for the most part, it's just because there's more eyes on it. There's more open interest. There's more average volume on the monthly than there is on a weekly. So from January 29th, if I figured that out, that would run me right to February 20th. And I really don't want to be pressed that much by, man, it has to happen February 20th or I'm screwed. So where I usually like to be at for these type of swing trades is 6 to 8 weeks. So the first thing I do is I kind of count the number of days of the move I marked, because if it replicated, I'd expect close to the same number of days in the move. But on top of that, I want to see more so where the best trade to make is. And usually in that 6 to 8 week range, you're going to make more solid trades and also have a little more time if it does spend a few days consolidating and such. So now we're to the point where I figured out an expiration, March 20th. I figured out that I like it because I think it just made a higher low and it beat on earnings, and that's what I was waiting for. What strike do I buy? Well, that's why I like using something like Fibonacci extensions, because just to think that you could buy calls if the stock moves up and you're guaranteed to make money if the stock moves up, it's actually wrong. I've had many, many trades in my career that I was in calls, the stock moved up, and I lost money. I've been in many, many trades where I was in puts and the stock moved down and I lost money. And that happens when you're trading too far out of the money. A lot of people like to think, well, I can buy a lot more of those cheaper contracts than I can the better trade. And those are usually the same people that spend their entire life saving losing money on penny stocks because their mind just doesn't work correctly. In reality, you'd be better off to buy one contract that's a more suitable contract for the trade you're making than 100 contracts that make no sense at all. So I want to pick a strike that's going to go in the money according to a target point. And I think the most fitting target point here would be that 25.22, which would be the replication of the move. And what type of strike, or what strike would I be looking at monthlies for GE if 25.22 was my target? They go in even dollar increments. So the $25 call would be what I'd be looking at. I think I'm the only one here tonight. The next thing I need to do after I make my first buy is what? Do I want to just be in this thing for one buy if it goes up to 25.22? Absolutely not. In fact, I'd really like to make multiple buys. 3. I'd really like to be in 3 buys by the time it hits 25.22. Now, will that always happen? No. Could it just shoot up the next day and hit your target and then start to fall? Yeah. But you see, before we ever even make our first buy, we need to know where our other buys are going to be. So at this point in our discussion, we would not have yet even made our first buy. Now, one thing you'll hear me say a lot, that stocks that are going to consolidate, usually on Fibonacci extensions, will consolidate between the 0 and the 23.6 line. And I like to use that 23.6 line usually as a second buy opportunity. Now, if I'm using daily candles, actually it doesn't even matter what time frame chart I'm looking at. Those of you that have been around here a while, what do I look at with candles? Do I care what the wicks on them were? Is that what really matters to me? The closing price. And the reason the closing price of the daily candle is so important to me is the stock market's open 6.5 hours each day. There's 24 hours in a day. So for 6.5 hours, those stocks, they move. They beep, 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 ping pong up and down, up and down. But for 17.5 hours, that closing price is what the majority of people see. It's what gets published in the papers. It's what goes across all your ticker boards for 17.5 hours of the day. So what I would be looking at on my second buy would be, can I see that I'm not just going to consolidate? And even though it doesn't seem like much in this case, you also got to realize our target point is not really that much higher in this case. So if we got a daily close above this 24.12, that's another point where I'd look to make my second buy. Where do you think I might look at my third buy at? Yeah, that last swing high, which is a prior high close, which is already kind of putting me up close to my target point. But remember, I'd be averaging up. So obviously by the time it crossed that, I'd be telling myself, man, I'm definitely right about this trade so far. And by the time I made this buy, my average would probably be closer to a replication of prices if the stock was down about halfway between this low and that green line, which is a good indication of a place I might want to buy again. The other thing that I'll commonly tell people to do is use something like a 8 simple moving average. Because that 8 simple moving average very rarely is going to get you the low of something before it curls. And remember, the time to buy it is on the curl. Now, in this particular case, you see it's actually already moving upwards, which for this kind of trade here would actually tell me that, I got to kind of scratch that as my idea for my third potential buy. But the 8 simple moving average, that's a short-term moving average, something that can help you out. So if it hasn't curled yet, that is a good point to also make a third buy. So I've got indications here on my chart of where I might want to buy at. I'm going to take my first buy here. Why? Why would I be okay taking this first buy? Hey, it still could come down some. All I need's a higher low. So it's got to have a daily close above 23.58, and I still like this trade. That means it could turn around and make a big old red candle and still not close below 23.58. So why could I go ahead and make this first buy here? Well, we talked about it being the higher low, but simply because I don't need a lot of confirmation for it. I'm not buying a full position size, am I? I'm actually putting a limited amount of money at risk at first. And where most people would look for confirmation to make a larger buy, and maybe just a single buy, I'm going to use that as a point to average up if I'm correct. So as time goes on here, would I be buying more of the calls on this day? Absolutely not. What about on this day? As you approach the close of the day, you're above that 23.6 line. I would say that's a good day to make your third buy. Or your second buy, I'm sorry. Now, as time goes on here, am I buying more on this day? What am I doing on this day? Absolutely nothing. It's done nothing yet to say it's a bad trade. It just had a red day, didn't it? Now, one thing you can kind of do on your red days to see if you need to maybe take them serious or not, look at your volume. I had a decrease in volume on the day. Okay, it was a red day. You know, look at your market that day. Did the market have a bad day? If so, that could be a good reason that that stock went down. Am I doing anything on this day? How about this day? Now, many times on trades that may have moved a little further than this, 60-cent move so far that we're going through on GE, this would actually be a point where I'd say, well, that's the high close from before, kind of broke it and pulled back below it. If I were going to sell some here, how much would I sell? Half of what? Half of what I'm holding, right? So if my first buy, let's just say I bought like 12 contracts, and my second buy here, I've only bought 8 contracts. How many contracts might I sell here if I was going to sell? There you go, 10, half of whatever I'm holding. And if I did sell half here, what is that leaving me for available to still put into the position? Two-thirds, right? Because if I sold half of what I had and I only made 2 buys, I would now only have a third of a position. And after taking some profit, I like to kind of factor profits taken during a trade into my average on what I've got. So in this particular case, your average would have been about 20 to 22 cents. And up here you hit 29, 30 cents. So about a 50% gain. So if I've got a 20-cent average, but I just made 10 cents, I'm going to kind of factor that for my own math as saying, sweet, now what I bought at 20 cents is really like 10 cents. It could go down to 10 cents and I'm not going to lose money in this trade. So what happens on a day like this where it actually breaks that point? And on this day, you would have seen that those contracts closed at about 24 cents, 23 cents. In the case that if I would have sold half of what I was holding here, having still available 2/3 to put in the position, even though this was my third buy point, I would have either bought all 2/3 right here or had told myself I'm buying 1/3 on the close And if tomorrow still opens above that green line, I'm buying the other third. So tomorrow opened, it actually gapped up, but did it open above the green line? So in that case where I would have, been out, or I've only been in a third of the position, I'd have bought the final third there after making a buy just the day before. Now at this point in time, and really at the point in time when you just get even your second buy in, if you ever get a swing where you're up 100% on your average, so let's say I bought like 12 contracts at 20 cents and 10 or 8 contracts at 22 cents. We'll just say I've got like a 20.8 average or 21 cent average. If those contracts get to 42 cents, I want to sell half of them. Why do I want to sell half of them? Risk-free trading. Take 100%, sell half. I get my initial capital back, and then I can see what happens. Now, if my entire trade relied on that target point of 25.22, which if you think about it, it did, right? That 25.22 is how I picked my strike. It's how I picked basically everything I was going to do. So even if I'm not up 100% and I hit that target, what do you think I should do? Well, remember, using this type of trading, we're going to buy in thirds and sell in halves. Buy in thirds and sell in halves. So even if I'm not up 100% at this point, but it hit my target point, I mean, let's face it, is there a possibility it breaks my target? Is there a possibility I was wrong on my target? Absolutely. Because, in reality, if I went to like a weekly chart, I could probably find a target that was a little higher than that. So by buying in thirds and selling in halves, today, there should be no question of, well, what if it keeps going up? It got a penny off the target, started to pull back some. How much of that position would I want to sell? Thank you for not listening, Bruce. Half. Why do I only want to sell half of it here? For Coach Mike, it hit your target. It could pull back tomorrow. Yep. But it could also do what? Yeah, it could break my target tomorrow. So I would look to sell half as close to my target point as possible. And what do you think, because this is actually today's date, 2/17, what do you think I would use as my trade plan for my remaining half? Exit the remaining half if well, you're talking about putting a trail stop on something that hit 40 cents and the minimum trail stop you can do is 10 cents. So you go from close to 100% gain to 50% at best just on your trail stop hitting. How about tomorrow if there's any indication it's pulling back? Like it closed at 25.17. Tomorrow it opens up wherever but starts to go down. You know what? That could be a pullback from my target. Exit the position and then run me another set of Fibonacci extensions from this high to the low to the high, and do one of two things. Say, okay, well now I'll look at puts down to this 24.11 target, or I'll just wait for it to get there and I'll look to trade it again. Now that particular trade got you anywhere from 35 to 55% profit, maybe 60% if you got lucky. Not a lot of people like to swing GE, and sadly it didn't really work out exactly like I like to, but our after hours trading group did this one. And it actually hit pretty much dead on our target point. But the point I'm making with going over these charts tonight in the way that I'm going to is you need to have a detailed plan for how you're going to trade it. You need to be prepared to wait for that plan. You know, the worst things people ever do is, okay, I'm waiting for this trade, but it's not ready today, so I'll take this other trade. No plan for it, but I'll take it. And then while you're in that other trade and it starts going sideways or something, your trade starts to develop. And you find yourself being exactly right on your trade, and yet seeing no reward for it because you didn't make it. But also in protecting yourself to be able to have some longevity in your trading career. Now, one thing that people always ask me is like, okay, well, you know, my account's a little smaller. I can't really do the scale in stuff. I've got people that trade GE with 60, 75 bucks per buy-in. You're talking like $250 per total position size, and they scale into it. The reason you can do that on stocks at this price range, that $15 to $30 range, is the contracts are actually fairly cheap. You can actually buy a suitable contract for, 20 to 25 cents. So, if you're doing it that way, your first buy might just be 3 of them. And when it goes up a little bit, you might get 2 of them. And on the third buy, you still might be able to get 2 of them. But I'll tell you what, when you're getting 50, 70, 100% on your overall average, it doesn't typically matter what you had in it. And it's still a way that small accounts can use the options to make these trades and profit off them pretty well. Going over to another one. We're going to come over here to RTN. This is Raytheon. Anybody in our after hours small group says, hey, we're in March 20th, $100 puts. Yep. And it's been consolidating since we bought them. How many buys do we have in this right now for anybody that's part of that after hours small group? How many buys do we have in these Raytheon puts? I guess I'm the only one here from that group. We have 1 buy. Another thing having a trade plan will do for you is it'll prevent you from being stupid and buying too many times in a time like consolidation. Consolidation can really suck. As an options trader, you're never really going to make any money in consolidation because you're not just trading against price when it comes to options trading, you're trading against time as well. So Raytheon actually missed the earnings estimates, but the entire sector kind of took off to the upside. and we were waiting for it to make an up move. And we got us a nice little set of Fibonacci's here. Now, during this consolidation, we took the March 20th $100 puts. Can anybody tell me why, based on the chart that I'm showing, we would have taken the $100 puts and not the $95 puts? Yeah, because the 95 wouldn't go in the money at our target. Now, seeing this consolidation here, and based on the discussion we had about how most stocks that consolidate will do so if you're trading via a Fibonacci extension system, you'll actually see them consolidate between the 0 and the 23.6 line. That actually looks really true on this one, doesn't it? That actually looks believable. So where do you think buy number 2 comes in? Yeah, a daily close below that 23.6 line, 105.96. Now, another thing that we're going to talk about with this chart that we really didn't get the opportunity on GE because it really wasn't there is another big mistake that traders make is they convince themselves of a trade. Like, I'm going to buy Raytheon puts, so it has to go down just because I'm buying puts. Have you ever made a trade that way? And like, because you're in puts, you fail to see the ability for it to go up? Truth is, you'd probably be lying if you said no. You know, anybody that's ever been on iHub before, and you read all the penny stock boards where people say long and strong, that actually is code word for long and losing my ass, stuck in this thing and losing my butt, where they spend all day trying to convince themselves of all the good things that can happen to make that stock worth holding. Hint, hint. The fact that it's on the OTC markets probably means that it's nothing more than a trade anyway. But you don't want to sit and convince yourself that a trade has to go your way just because you made that trade. So one thing that I like to do, I call it eliminating bullish or bearish arguments. So if my trade plan called for a target down here at 98.54, where along the way do you see as a bullish argument? Meaning, if I'm right and it does go down, where could it bounce from? Where could it bounce from? What do you see on this chart, even just in that recent up move, of where it could bounce from? There we go. That gap fill could be a potential point. And that's probably the most obvious right now, right? But how about too, that lowest close point? I like to mark those. And do you see maybe another point, maybe above the current price, where if it closed the day above that, I'm probably wrong on my thought that it will go down. Probably about something right there, right? Now, what these lines indicate on the chart is, I have no problem taking my first buy. I have no problem taking my first buy while something's consolidating. No problem at all. But rather than just, well, it's been a day, I got to buy some more, I want to be a little bit strict on myself on when I'm going to make that second buy. So failing this 23.6 line is going to be a pretty important thing. Now, let's just assume that over the next couple days, this thing starts to look like this. What do you think I want to do right here at the end of the day on this day if it were to start to look like this? Which, by the way, a failure of that line would probably be my third and final buy, where I got one buy in consolidation, one buy if we get the daily close here. Yeah, if we actually bounce off of that bullish argument, I'm probably going to want to sell half of my puts. Now, what happens if the following day does this? Remember, if I sell half here, I've only got a 1/3 total position right now, and then this day happens. Well, I'd buy at least 1/3 here. I'd buy at least another third there. And I would tell myself, hey, if it opens below that line tomorrow, I'm taking the other third. Now, let's just imagine for a second that this booger makes this big old down day and hits right on that target. What do I want to do? I mean, even if it closes low a day, no bottom wick right on my target, what do I want to do? I want to sell half. Well, and some people would, but I'm always willing to give back some for the potential to make more. Which means, the next day, if it started going up, oh, okay, maybe I should have sold all of them yesterday. But really, it's a 50-50 thing as to whether it keeps going down from this point. So I would keep the other half just to see what tomorrow brings. Now, going back to just being in this 1/3 buy right now, I don't ever like to stop out if I've only got a 1/3 buy in it. Again, to reiterate why, like I've said, if you can't tolerate a 50% loss, don't even try to trade options. And if I've only got 33 1/3% of a full position size at risk, then quite literally, I kind of don't care what it does. I could be wrong on puts and then it break above this line, buy calls, be wrong on that too, couldn't I? But let's say during this time, I've only got that 1/3 buy and it's a puts buy and I'm looking for, what, I think this thing's going to go down. And if it goes down, I want to be in it for that. So I'm going to buy my little puts buy here. Another big mistake that traders often make is when this thing turns around and does this, when they should buy calls, they convince themselves that, well, it can't go up because I'm in puts. You ever done that before? I'm in puts, it can't go up. You might not say it that way, but you don't buy the calls because you'd rather just sit and stare at your puts. Or you keep buying more puts. Yeah, I've been guilty of that before. We all have. Let's not sway away from that. You know, in reality with trading, human error is what makes it fun. Also what makes it a pain in the butt. But you have to quickly adapt. You know, I talk about lines on my chart oftentimes, not necessarily being swing points or Fibonacci points, but reaction points. Because in reality, if you're going to put a line on your chart, you have to be prepared to react based on what it does in correlation to that line. So if you use all them squiggly giggly lines and you're convinced on the Jeff Williams theory that if 17 indicators go one way and these 3 go the other way, that's a buy signal, then you know what? Be prepared to do it. Don't have them on your chart if you're not going to trade with them. There's a reason there's not a single indicator on my charts. But when it comes down to it, by not just loading the boat on that first buy for your swing trades, you actually, believe it or not, what you're dedicating yourself to do the minute you take that very first buy, you know, let's say that your position size is $900. If you're going to buy in thirds on a $900 position size, how much money are you going to put into each individual buy? $300. Now what if you could buy 2 of something for $220, but 3 of them would be $350? There you go, Grant. You don't spend more than your position size because then you get a little lopsided and unhealthy. But you see, if your position size is $900 and you make that first $300 buy, you should not look at your account and say, oh, I got $600 to do whatever the hell I want with. That $600 is already spent, isn't it? It might not look like it's spent sitting in your account as settled cash, but when you make that first trade entry, the other 2 blocks of money you need to keep available. What are a few reasons that you can think of that you would want to keep those other 2 blocks of money available for that stock once you make your first buy? Just a couple reasons why you would want to keep that money available. Well, you know, in reality, you're kind of both right on that. If it does what your trade plan called for, you've got to be prepared to buy it today, right? Not, well, I guess I got to sell something so I have settled cash for tomorrow, because your trade plan said to buy it now. But also, with options, it allows you to kind of protect yourself, because let's face it, can stuff make like one ugly red day but still be in an uptrend? Or can stuff make one really wicked green day but still be in a downtrend? And sometimes the worst thing to do is just bail on everything, because then tomorrow comes and it gaps the other way and you're like, shoot, I sold that at the worst possible time. If you're trading common stock, you don't really have that luxury. You generally just have to stop out. But with options, options have enough volatility that you can generally, in a pinch, before you stop out on one side, just take the other side. Give it another day to see, you know, does it continue? If it continues that second day, well then, you know, if I'm in puts and it did this, well, let me take a third buy on calls, And then tomorrow, if it does this, even early in the day with just continuation, I say, you know what? That's probably not a puts play anymore. Right? So I'll exit out of my puts. And even if I think it'll go down in the longer term, well, now let me look for a couple areas it could go down from. And I'll wait for it to hit one of these lines and pull back from it. And then I'll buy puts again. But would my target point down here be any good if we had a candle that looked like this? Absolutely not. Absolutely not. So, another big reminder for people is if you dedicate yourself to a trade plan on a chart, whether you've spent that additional money yet or not, leave it as cash. What do you think one of the biggest mistakes pertaining to this example is that I see, like when I talk to people about, well, hey, how come you didn't make the second or third buy on that one? You're only making one buy on these, and yeah, I got one buy on the losers, but I got 3 on the winners. What do you think the number one reason is? Well, I mean, obviously they spent it on something else, but what do you think their rationale was for why they spent it on something else instead of waiting for that trade? And it's a pretty alarming statistic, because quite literally what I get with it is close to 90% of people that I have this discussion with have the same answer. Well, I figured rather than it just sitting there, I could make money on it. I could use that money to make money while my trade set up for me to make the further trades. A pretty good friend of mine once said, trading is about monitoring your risk and letting the reward take care of itself. The common mindset for traders when they start is focusing on the reward. I use the analogy, don't get caught staring at the moon and not realizing you're standing in quicksand. A lot of times you just have your eyes set on that iHub board that said this stock that's trading at 0.0003 is going to $1, and you're not realizing that when there's no bids, even at 0.0001, you done lost your butt, because you're just looking at $1 and how much money you're going to make when it goes to $1. Don't get caught looking at the moon, not realizing you're standing in quicksand. When you scale into your trades, especially for swing trades, and I want to ask you this question because this is a pretty important thing for most people. Many times I talk to people and, so what kind of trading are you looking to do? Oh, I want to be a day trader. Why do most people want to focus on day trading? And it's a reality. I mean, most people want the short-term trades. Yep. And quick profit also means quick what? Quick losses. In reality, with your day trading, let's just face it, who here has come in and tried to focus only on the day trading and, man, I'm losing money quick. I know that back when I started out, when that's what I focused on, it seemed like I lost money really, really quick. I'd make some money here and there, but I lost money really, really quick. And as crazy as it might sound, if you're one that's been losing money really, really quick, swing trading is probably for you. And the reason I say this is that the same tools that you use to plan your swing trades can be effectively used to plan your day trades. with the exception of time. With swing trades, you have time. You're trading a candle for candle basis, and on a daily chart, how long does it take for a new candle to close? A full day. A full day. So, you know, one spike in one direction might suck today, but when you still got 4 or 6 weeks left on your trade, it might not be that bad for your trade other than the fact that you're down today and maybe for a couple days. But let's face it, those of you that try to focus on the day trade and you go down on the day trade, you don't have time on your side, do you? And I know from the emails I get from people when they are struggling, it's not like they're selling those either. Or it's not like they're quickly jumping into the other side to take the other side. It's, you know, I bought puts. This thing better go down. And oh, crap, it didn't go down. What do I do? What do I do? What do I do? And then I get an email 3 days later. I get an email on Friday afternoon at 1 o'clock. And, you know, by the way, I don't check my email when the markets are open because I trade. And I've never made money checking my email. I have to watch stocks. So I get an email at 1 o'clock in the afternoon on Friday. Hey, I bought this Monday for $3 and there's no bid on it right now. What do I do? And at 4:15, 4:30, when I start answering my emails, I say, well, you couldn't have done anything if there was no bid on it. But, you know, when all you're doing is focusing on the short-term stuff, understand that you'll make money quicker and you'll lose money quicker too. This is why I generally always advise newer traders to focus on swing trading. Because again, the same techniques that you're going to use on that daily chart, where quite literally full days can go by and have not that much of a long-lasting effect on your trade in the event of like Raytheon here. Since I bought my first buy on puts, it's had an up day, a down day, an up day, a little down day, kind of an inside day, a down day. Pain in the butt. But it really hasn't had that much of effect on my trade. It still has done nothing to show me that it's going to go up, right? I mean, look at this chart right here. Has it done anything to indicate, hey, this thing's not going down? Well, the fact that it's going sideways, okay, but has it indicated that it's going up? Absolutely not. But if I only looked at like an intraday chart, if I pulled this up on a 15-minute over the past couple weeks, there was a lot of times that it looked like it was going up, right? Even though for my trade, those moves actually had little to no effect whatsoever. Because I made the buy-in consolidation. And I'm waiting for a break from consolidation to get larger. So even though my contracts are, let's see, down about 35% because it's taken 2 full weeks to move, there's nothing here that says it's going up. And therefore, there's nothing really to say that my trade won't result in a winner. I have a lot of trades that after I buy them, they go down and still get sold for winners. I have a lot of trades that you look back at them and say, yeah, maybe I should have stopped out of that. But for what we're talking about tonight, simply scaling into the trades is a way that you can use to kind of keep your risk a little smaller and increase your risk, but only at a point where the chart says, hey, I'm confirming what you thought. let's put this into an example on another stock, even looking at like intraday moves. We'll go to Apple's 15-minute chart. I can use things like my Fibonacci extensions at different points on the chart to give me target areas, and in this case it gapped up over a target area, which would say, hey, use that as support and see where it goes until you can get a new line on it. And then you have to kind of figure all of this one big up move, and finally made a decent little pullback. And so we'd be looking at this little target up point. Well, we got pretty close to it here, kind of close to it again here. Here we actually hit it and pulled back, and I would have probably sold it there. The next thing you got to kind of look at is where the next move would be. And how you could further your trade in it from that point. And really simple, while it's consolidating, hey, I think Apple's going to go up. So you make a little buy. Oh, hey, it broke my 23.6 line. I'm going to buy more. Well, through the process of continuation, and you'll actually see that there's a few little other points that would come along the way here. You would have had a low, a high, a low here. That when you made this buy and then you said, well, hold on a second, that one kind of hit that line and pulled back, sell half of them. Well, when it breaks this line here and you've already used up that one, mark the points that it gave you. Make another buy when it crosses that 23.6 line. Okay, you didn't quite get to your target, but you still didn't fail down below that 23.6 line. It still wouldn't be an absolute failed trade. But you can actually, many times, scale into your day trades using the same types of systems you would use on your daily chart. I find it a little bit harder at times to really get like 3 solid scale ins using anything smaller than a 1-hour chart though. And for instance, from when Apple had its earnings. Now, first of all, on a 1-hour chart, how far am I typically trading out? At least the following week, right? So not as bad as a time decay hit on the overnights. Well, as this trade starts to develop, let's zoom this in and we'll go back to right in here. As this trade starts to develop, you'll find that you might get some different target points that come along the way, after it made this little dip. Okay, we'll look at the point where it breaks that 117.18. Okay, it broke it here, it held it. Okay, let's maybe take some 120 calls for next week. And as it goes along, you've got several possibilities. You say, hey, this is a W pattern right here, isn't it? Or even when it breaks here, you're just breaking a swing point. Each of these could be additional buys. So buy number 1 could be on this break here. Buy number 2 could be one of 2 points. Hey, I made a higher low, it's starting to go up, or when it breaks here. And then buy number 3 when it breaks this point, still having a full $1 to go to my target. And options are a game of $1 moves. I say that because when you read the definition of the delta, the gamma, it's all based on $1 moves. So as we start to get into a trade like this, and you're kind of bebopping around, well, you might have had another point where you said, well, let me adjust my target a little bit. And you know what? It got up into here, it pulled back. I'm going to get out of that one. So now you're out of it, and you're looking. You still got maybe a longer term target that you kind of have in mind, and you start to make a little bit of a move. Usually you see it when you maybe break a new high or make a decent pullback. You see here, it's like, wow, from that last pullback here to right up in here and right over here, wow, I could hit this 121.30. So I'll make my first buy when it crosses the 23.6. And you know what? If it comes up and makes a new high, I'll at least get like a second buy on it. So let's see what it does. Well, in this case, it gaps up and the first candle hits your target and pulls back from it. What are you going to do? Well, dang it. I didn't get my additional buys. Oh, well, it happens sometimes. And then you go, hold on a second. This thing might actually break this thing. Well, as you go through the use of Fibonacci extensions, which we're actually going to go in depth in next week, you'll see that you get smaller moves, but it's all about visible up and down moves. Higher highs, higher lows, lower highs, lower lows. Well, you actually got a point here where you moved up, you made a higher low. Okay, so all of this into its pullback would then also be a target point. Okay, now I got this 122.86. Let's see. Okay, across that one, let me get rid of this one. Maybe use that as a point where, hey, it broke that one. I'm going to buy more. Oh, man. What do I got now? This son of... Man, I'll tell you what. It's broke all my little sets. It might be trading on this big set now, 124.29. Okay, that's what I'm going to look at. If it hits 124.29 and pulls back, I'm going to sell. Well, candles are getting small. Man, tell you what, that'd be a pretty good sell. But guess what? It started breaking again. This son of a gun, you just can't win on it. And sometimes you'll have that. Sometimes you're like, you know what? It broke this. I don't have another target on this 1 hour chart. So I'm just going to use this 100% line as my support for now. I'm going to make a buy. I'm going to let it play this game. Okay, it gapped up. Oh, you know what? That's not really a pullback, but I might have to use it. This thing's really starting to get crazy, so let me kind of see how things transpire on it. And I'm going to kind of go here, and holy cow, that could take me up to 134.62. I don't know if I really trust that target right now, but you know, if it breaks that 23.6 line with the close of a candle, I'm going to have to. Well, shoot. Guess I'm going to have to trade for that one. Now, during that time, you also got another little set that happened here. And you'll see that that candle actually broke that. So you wouldn't have traded for that. That's too small of a move. And now, where you were buying off of that 23.6 line, it's kind of coming back to it. Now you're kind of sitting and holding up. But if you stay consistent with it and make every trade the system points out to you, and like I said, you can actually scale in using that 23.6 line and a swing point break, a prior high break, or prior low break if you're playing to the downside, on your 60-minute and do some shorter term trades, trading out to the following week's expiration, and apply the same type of stuff that you do to a daily chart onto your shorter term charts. But see, the problem comes with the emotion. A lot of people, man, I want to start out and, let me go to a 5-minute chart. And they start out on that 5-minute chart, and then they pull a won. You know what a won is, right? Holy cow, Apple's breaking out! It's going to the moon! Just because on this chart, that looks like a big candle. Oh man, it's really breaking out now. Well, it just moved like 40 cents. That's not that big of a move. But yeah, if you're in calls, you're enjoying that. But see, then he also goes right over here. Oh my God, it's crashing. when it's really not. But when you're living off a 5-minute chart or any shorter term chart, your life revolves around very, very short term moves. Now, if you have a lot of money, when you see, this type of move, oops, you made this little pop up, you pulled back, and you're starting to pop up, okay, from 127.15 to 127.80. Yeah, that might make you 30 cents, 35 cents on your options. If you've got a lot of money, well, that might be worth it to trade it for you, especially if you've got the ability to stop out without thinking about it. A lot of people don't. And then see right there, oh shoot, hit that, pulled back from it, out of that little scalp trade. But then it takes off again. Oh shoot, where do I go? Where do I go? I've got a down move here. I got this. Okay, it could take me up 129.15. We're going to trade for that on this breakout. Okay, let's see where it goes. So it's kind of stopping a little short. And as this is going by in 5-minute increments of your life, you're having to quickly adjust and say, okay, now this can't go down below 127.40, and it'd kind of still be okay. Okay, hold on a second. I got another up and down move. Okay, that just gives me a higher target, so I'll kind of sit in there and let it go. And kind of looks like we might be coming down, so let me go to the last high here and low, and high and low and high, which doesn't give me much room to really work with. Oh, and it went below that, so now I got to get rid of that. Oh crap, now where could it go? Because it made a pullback bigger than this one, and now I got to go back to this one, monitor its pullback size from this high, and okay, and all this has happened 5 minutes at a time. And I can tell you just from experience of working with new traders, they don't think that fast. Okay, it almost came down to that target point. It's starting to move up again. Okay, where could this move up to? And during this time when this is coming down, they're freaking out. In reality, this move didn't hurt the stock, but also in reality, it could have dropped to like 124 and they'd have probably still been holding their calls because you know what? Oh, I got this target point right here. I can't quickly adjust to things. And then again here, oh shoot, that's starting to look like a lower high. And the inability to adjust could have you making very, very poor decisions. So even though you could make some money quicker by focusing on day trading, you could also lose some money quicker. And the other thing, I get a couple private messages I had come in while I was talking tonight, and I've got 11 of them here, and 7 of these people asked the exact same question, maybe worded it a little different. If I scale in and I'm doing smaller trades per entry, don't that mean I'll make less money? You're exactly right. You'll lose less money when you're wrong. Pay attention there to how I said that. If you take what we were talking about today on your daily charts with something like a GE when we talked about scaling into that trade, and if you're scaling in with smaller money, you can lose less money. People don't get online and Google search or however they find winningstockcoach.com because they're making lots of money. They find a place like this because they're not making money and they're hoping that they can come to a place and make money. That right there is your key reason to not worry about, oh, if I don't put a lot in it, I can't make much. And to start focusing on, if I don't put a lot in it, I can't lose much. Once you establish a history of trades, then we can talk about making those positions bigger. But until that time, trade small, lose small. And that type of thought process can really, really protect you. And when using the type of trading system we talked about tonight with scaling into your swing trades, it can protect you in a way that will allow you to verify being right before you put more money into it. And having the confidence to put money into it when it does what you thought it would do. Because let's face it, if you're looking at all these little moves and it's like, okay, we talked about on GE, as we started kind of planning out that trade, and we had our Fibonacci extensions from this low to this high to this low. Okay, I'll take my first little buy. If it crosses over that 23.6 line, I'll buy. Okay, it did that. I might be right about this trade. Okay, now it's kind of jacking around. Wow, that's where my third buy was going to be, and it did that too. It'll also give you the confidence to say, hey, I thought it was going to go to 25.22 and it went to 25.21. That's pretty darn close. And don't be arrogant enough to think you're going to pick the exact penny of something every time. I'm not. If I make it within 0.5% of a target point, I'm happy. But when it does exactly what you planned for it to do, don't be afraid to act upon it. But act upon it in a way, if you're going to use this style of trading system, act upon it in a way that isn't dependent on your emotions each and every day, rather is dependent on your emotions this day. And maybe even when the market is closed after this day. Why? Because when you do that, it will give you the ability to say, I don't even know what it's going to do yet. But if it does this and this and this, then that means I was right. And I want to trade it if I'm right. So every time I'm right, I'm going to put a little more into it. If you simply go, all right, I think it could go up. I'm going to put all my money in it right now, and oh my God, I hope it goes up. You're going to be an emotional wreck. Reward yourself when you are correct. Hey, that crossed my 23.6 line. I made my first buy. I knew it was riskier, so I put less in it. But that did what I thought it would do. And I said that if it closed above that point, I was going to buy more. So I'm going to have the confidence to do it. Okay, it's kind of jacking around. And yeah, this is 4 or 5 days later. So what? Man, it just made a higher close on the daily. After making the higher low, I'm expecting a higher high, and my projection point's 25.22. This was kind of my resistance point I had to break above, and I did it. Man, we're starting to, oh wow. I put that line on my chart saying that's where I thought it could go. And it came 1 penny from it. I might want to start getting rid of some of this. Do I know if it's going to go up tomorrow? No, I don't know that. That's why I'm only going to get rid of some of it. And then if I'm right, that 25.22 area is the high, then that means tomorrow it'll go down. And if it goes down tomorrow, I'll sell the rest of it. But you see, when I go further on this chart, tomorrow hasn't happened yet. And again, if you plan your trades on this day and simply execute based on what your trade plan said to do, then you are going to find that, again, as you are right, as you confirm that you were correct, you will get larger in the trades that you should be larger in.